Okay. Our next presenter is Mr. Berisford Grey. Berisford Grey will speak on the topic of how and why we raise additional capital. That's a sort of a testimonial. Beris is widely considered as one of the region's top investment bankers. As one of the founders of Sygnus Capital, he's living out his passion to create leading non-traditional financial institutions firm that uses creative approaches to unlock capital for clients. His career was launched in the European debt and capital markets, where he worked as an associate director in investment banking, with particular focus on securitization and structured finance. After returning to the Caribbean, he held key positions at leading regional banks, where he used the out-of-box thinking to generate game-changing results. This includes setting up and driving Scotia Investments Capital Market Unit to become a leader in the local market within 3 years, and contributing significantly to the turnaround in CIBC First Caribbean's corporate and commercial banking center between 2013 and 2016. Beris has the knowledge and talent in leadership skills to move Sygnus Capital forward. He was an MBA in entrepreneurial finance from the Leuven Management School in Belgium and a master's in economics from the University of the West Indies. He has also completed a one-year executive leadership program from the very heralded Wharton School of Business in Pennsylvania. Now, invite you, Mr. Grey, to join us to make your presentation. Ladies and gentlemen, over to Beris.
Thanks very much, Andre, and good morning to everyone. And I must start by saying thanks to the JSE for inviting me to share my thoughts on this very important topic of raising capital and how do you actually do that, especially equity capital within the context of the current environment. And I also want to commend the JSE for continually pushing initiatives to move our capital markets forward, deepen the knowledge base across Jamaica and the region, and exciting, I would say, the diaspora about the Jamaica equity markets and capital markets in general. So what I will do, I will share some thoughts primarily around why Sygnus Credit Investment, our private credit investment company, actually raised equity capital in December 2020. And I will also talk about some of the benefits associated with raising equity capital versus debt. And Marlene indicated at a very high level some of those benefits, but I will, re-emphasize them and say that Sygnus Credit Investment actually enjoys some of those benefits, and I'll point to those examples. When a company look at its strategic plans, whether it's growing organically or growing by acquisition or developing and launching new products, and it has to think about how it will fund its business activity. And you normally have the decision to either fund it from cash flow or go external to the capital markets or the bank market to raise equity, obviously, or debt financing. In the case of Sygnus Credit Investment, that focus on investing in primarily in medium-sized firms across the Caribbean, the decision that we had to make early last year was, how do we grow the business consistently over the next 2 years, over a 24-month period? And we came up with a plan to raise capital in the form of debt and equity. Unfortunately, in March last year, we entered the pandemic, and I think Jamaica shut down in and around March 10th, almost 1 year ago, exactly 1 year ago to be exact. And as a consequence, we had to push back our desire to do an additional public offering. And, you know, we actually was paying keen attention to the capital markets last year and to see how things would evolve. You know, during that time, of course, we had many companies who we invest in, and other companies in across a wide array of sectors, medium-sized firms in energy, hospitality, especially distribution and manufacturing, who were all making plans to weather the pandemic and and manage working capital flows. And as a consequence, in our portfolio, we had companies who needed working capital support. We also had companies who were in the distribution business who were seeing a spike in demand for healthcare products, whether it's mask or sanitizer, you know, those type of products that had a spike in demand. So they needed working capital, not for liquidity purposes, but for growth purposes. So we were very, I would say, keen to see the capital markets come back to some level of normalcy. And I would say I was actually quite jealous away, so to speak, of the US market that has a very mature alternative investment market and a very mature capital markets. Because in the middle of the pandemic, you know, June, July last year, September, if you were tracking the US market, you'd have seen huge IPOs, including IPOs later on in the year, such as Snowflake's, Airbnb, that were raising billions of equity capital. On the alternative side, you have the big players such as Blackstone, Beris Capital, Carlyle Group, Adrian, that come out of Europe, were raising a record amount of dry powder. That is basically additional capital in terms of equity, or launching new equity funds to basically either, in the case of, say, Blackstone, position themselves to take advantage of equity investment opportunities. In the case of private credit companies like ourselves, to position themselves to take advantage of the increase in demand that they expect from portfolio or medium-sized firm. Because naturally what you have in pandemic is that credit and debt facilities from the traditional source is normally pulled back, and rightfully so, because that capital is not as flexible as equity. So we were very jealous, so to speak, of what was going on in that market. But we also understand that our ecosystem, both in terms of alternative investment and capital markets, and the depth of it is at a different stage. So I was very excited, and I made reference to this earlier this year at my presentation at the Jamaica Stock Exchange Conference, when Barita was able to launch a very successful APO, because that tells me that the market was coming back. And as a consequence, Sygnus moved very quickly to organize with our brokers and arrangers to launch our APO. And I was, or let me say, the Sygnus team was very focused on executing this APO by the end of the year. And the main reason for that was, we know that we need to raise this additional equity capital so that we can focus in 2021 on starting the year with a lot of dry powder. And the dry powder in the form of equity is very flexible. It will allow us, and it has allowed us to be very agile in terms of responding to client needs. It allows us to take position in investments which are more patient, and that's really needed in an environment like this, where we have to understand that business and normal business activities are unlikely to come back until the back end of this year, 2022. So we can't invest in a medium-sized firm that is involved in, for example, distribution or manufacturing or exporting for that matter, or transportation for that matter, and expect that they will start delivering the level of performance. With dry powder in the form of equity, we weren't under and is not under any pressure to either make large interest payment or thinking about if there's a credit event, for example, we will have to unwind those positions. So that allows us to not only be more agile and strategic and customized in the way we support our investment in medium-sized firm, but also enhance our capacity to take a long-term view. And that's one of the key reasons why we raise equity capital rather than debt. The other reason we had to do that too is that if you saw our results as of December, because effectively we took on a bridge in the middle of last year once we saw that we were going into a pandemic. We took a bridge facility just to ensure again that we have dry powder. And that bridge was expensive. So our interest expense went up significantly. I think it went up from 100,000 the year before to about 900,000 by the end of December. So equity allows us to extinguish that debt, and in a pandemic, you don't want to have a lot of leverage if you don't need to. And again, that's because leverage imply continuous drag on your cash flow because you have to service that debt. With the equity that we raised, we were able to pay that down and reduce our interest expense significantly. And looking forward, if there is any shocks to our balance sheet or shocks in our income in terms of net interest income, we don't have that issues that when you have a lot of leverage, you will have in an environment like this. Most importantly though, by raising approximately 27 million US in new equity, that allow us to position ourselves nicely looking forward into the future, whereby we can now leverage we can raise a lot more leverage once the market has normalized, because our capital base would have risen by over $27 million. So if we were raising, for example, today or last year, so to speak, 20 million in debt at a 1-to-1 ratio, if we keep maintaining the same ratio, debt to equity 1-to-1, we are talking about taking on more than $20 million more in debt. So leverage, which will help us to generate greater return for investors at the right time as we build out as we grow our business, because we have strengthened our equity base by raising additional equity capital. We are now in a stronger position to achieve those objectives. On a whole, equity capital allow you, and in the case of Sygnus Credit Investment, not only to execute your strategic objectives, and in the case of Sygnus Credit Investment, our strategic objectives over the next 24 months, we are now almost 6 months into that process, is to grow our private credit portfolio to over 100 million. At the end of December, it was roughly 67 million. So we expect that within the next 18 months, we will be at 100 million. And 100 million with a stronger balance sheet in terms of equity base, as well as more, even the same leverage ratio, and yet we will have more assets that are highly customized to generate the type of returns that we want. My final point on the benefits of raising equity capital, and as in our case, again, an APO, and I'm always very excited to see firms raising APOs, additional public offering rights issue, and IPOs in the market. One of the big benefits is that you get the chance to reintroduce your firm to a wider set of investors. We get, for example, in our case, we get to tell this story to to investors who did not have a chance or did not participate in Sygnus credit investment back in 2018 when we did our IPO. These investors effectively now have a chance to see how the firm has performed and had the opportunity to participate in the growth story to deepen the Caribbean private credit market. So you will reintroduce your brand to the market, tell the story to new investors, show to existing investors, whether it's institutional or individual, that you have achieved what you said you were going to achieve. That build credibility for your firm, that build credibility for your brand, and most importantly, create a deeper emotional sense to your existing and new investors. And that's very important for long-term sustainability. So those are just from, no time is against us, but in a snapshot, those are some of the benefits of raising equity capital and in the form of an APO from SCI perspective, and especially within the context of the current environment where we have a pandemic. You need to capitalize as much as possible your balance sheet with patient, flexible capital that can take a long-term perspective on investment opportunities. Thank you very much. And I will stop now so that
thank you, Beris.
Address any question.
Just one quick one from me, Beris. Thank you very much. Dr. Lawrence's presentation spoke to how you deploy the capital that you receive. You address more now of the timing of that deployment and how do you make that decision? Having raised the capital now, you decided that you're going to invest it A, B, C, and D, but the market has changed, the environment has changed. What happens in the interim when you hold back on deployment of that capital? What happens? How do you make that decision?
Okay, yeah, very good question. And from Sygnus Credit Investment and the whole Sygnus Group plays and focus on the alternative investment market. The alternative investment market for the big platform in that space is private equity, private debt, and real estate financing, hedge funds, etc. The reality, venture capital and support. The reality is that because of our focus in an environment like this, we have different vehicles and that looking for different type of risk. And we are looking, in the case of Sygnus Credit Investment, at medium-sized firms that have strong businesses before the pandemic and have strong outlook for growth or continued growth post the pandemic. So when we are going to deploy capital, we are going to look at a business and the sector that's in and say, is this business a business that really need that little buffer to cushion it and take it through the current environment? And if we feel, well, based on our analysis, which we look at everything in terms of forecast, past history, collateral, etc., if we are comfortable with those metrics, along with the management team, which is really the crux of the matter from a credit point of view, at the end of the day, we really invest in people and the capacity of a team to execute and manage a business correctly. Then we will structure a credit deal that will have a customized solution, i.e. it might be preference shares, it might be a loan that have profit upside so that now they have a very low coupon or a coupon that is probably even accreting now and then pay us in 1 year time when as the business pick up and so forth. So in deploying capital right now, we are very cautious, but at the same time, we are finding companies that have good platform, good asset base, good business models. It's just that they are going through a very contracted economy because of the pandemic. And but we believe in the leadership team of those businesses to take the business through. My final answer to that as well is that what we have found out is that there are businesses in our portfolio right now that had entered the pandemic with strong cash flow, with strong war chest, so to speak. So when the current environment affected other players in their industry, their strategy was to expand their business by acquiring entities. So in that scenario, we will sit with them and understand fully what is the plan, and then again create a solution to help them to execute that that opportunity.
Okay.
There are also business that we, and quite frankly, that we had to provide working capital support to, because again, as I said, sometimes a business in distribution, if sales fall and inventory is stuck, not moving, but this is a good business, good leadership team, and you are secure, have a good line of sight of how the business operate. The alternatives, the demand of alternative investors like us is to support medium-sized firms to really weather shocks in the environment.
Okay. So there must be some nimbleness in the deployment plan as well, then, is what you're guiding people to say. Fine.
Correct.
Thank you very much for that. Thank you very much for that. Thank you, Beris. Excellent presentation. Very insightful, and a testimonial of how to raise and deploy additional capital certainly supports Dr. Lawrence's points. I'm now, thank you again, and I'm now going to hand over to our next presenter, none other than the Honorable Michael Lee-Chin, who by himself needs no introduction, but certainly a man of this stature, certainly we need to follow the proper protocols and give him the due recognition. And Mr. Honorable Michael Lee-Chin certainly is the entrepreneur with the philosophy of doing well and doing good, has resulted in extraordinary business success and inspirational philanthropic initiatives. As Portland Holding is a privately held investment company that manages public and private equity. Mr. Lee-Chin has had an ownership interest in a collection of diversified businesses operating in various countries and across numerous sectors, including financial services, insurance, media, tourism, agriculture, real estate, and targeted radionuclide therapy. Among his personal accomplishments is that Mr. Lee-Chin has received a Doctor of Laws degrees from a number of distinguished universities in Canada and the Caribbean, and in 2008 was awarded one of Jamaica's highest national honors, that of Order of Jamaica, for his significant contributions in business and philanthropy. In 2011-2016, Mr. Lee-Chin served as Chancellor of the Wilfrid Laurier University. In 2016, he was appointed Chair of the government's Economic Growth Council, EGC, in an effort to bolster economic development. He was also appointed the Order of Ontario in 2018, the province's highest honor reserved for those whose contributions have shaped the province, the country, and beyond. Ladies and gentlemen, please join me in welcoming the Honorable Michael Lee-Chin to make his presentation. Welcome, sir.
All right, Andre Neville here. Just give us a few minutes. We'll have him on for you.
Okay. All right. In the interim, I think there was another question in the chat. Yes, Beris, I want to know if you could manage this one. It's, what are the steps to be taken to prepare a company to raise capital?
Sure, Andre. Sure. Well, the key step to, well, it depends. Let me start by saying, what if you are doing an IPO, the steps are a little bit different than if you are doing an APO. But fundamentally, one of the first steps to undertake is to, assuming that a company already look at its governance strategy or its governance setup, where you have a proper board in place, you have proper accounting and operational processes in place, right? So those are a big, those are some work you have to start maybe a year or two before you actually start thinking about going public. You have to ensure that you put proper accounting system and management in place, a proper board. In terms of the actual capital markets efforts, the first thing to do is to appoint a reputable broker. You call that broker a lead arranger or a lead broker. And that broker will then pull together a team, including attorneys, etc., to pull together the prospectus, help you write the prospectus, analyze the value of the business. They will then take you on a roadshow, which is basically presenting your business to potential investors to let they understand the business. And, you know, once the transaction goes through the regulator process, i.e. the Jamaica Stock Exchange, the Financial Services Commission, Companies Office, etc., then your lead broker will launch the transaction and engage in the sales process with both institutional and individual investors. But so it's the first step in the capital markets activity is to appoint a good lead broker or lead arranger.
Okay. What about private capital? We're not talking IPO or APO here now, but private capital.
Yeah, private capital is a little bit easier. Well, let me say the process is a little bit easier from a disclosure point of view, but the effort is the same. You have to, again, have a business that is put together from a financial accounting point of view, a good board. And then once you appoint a lead broker, your lead broker will help you to write information memorandum. They will then register register the transaction with the Financial Services Commission under what you call the exempt distribution guideline, and then they will do a roadshow, which is normally even more extensive, so to speak, than in terms of meeting and drilling down with institutional and high net worth investors who are accredited investors. There are some limits in terms of private placement, and they will manage that process for you. Again, a lead broker, the right lead broker, lead arranger will basically navigate you through the private placement.
Okay, all right. Thank you very much, Beris. Mr. Lichin, I see that you